Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Well, I've been talking a lot about the markets this morning, a lot about the coronavirus and the fears and the effects that's having on the markets. Another area has, of course, been the political climate. That's another area for volatility, and we've seen the good and the bad of that. We'll see. That's not over yet, of course. It's an election year, so we're probably still going to see some impact. We certainly did back in 2016. One of the things that comes into that is, again, start with the basics of when you're preparing for retirement, or whether you're 5 or 10 years out from retirement, whether you're about to retire or have been retired for some time. It's never, if you haven't sat down and really drafted up a plan, and by that, where you've looked at all the different areas, including and most importantly, right, your investment plan, how you're going to make sure you have the income you need in retirement to do all the things that you want to do, and not have to worry about market downturns or volatility impacting your lifestyle, that you're going to be able to, that you've got a plan that's going to allow that to work through. So I'll give you an example. Strategies that I use at the office. One of those being a laddering strategy. And by that, what we do is we look at typically in 5-year increments. And I talk about it in my book, by the way, 7 Steps to Financial Freedom in Retirement. We refer to them as your short-term fund. All right, so your short-term fund, basically what we're talking about there is money that you're going to need over the next 3 to 5 years. Okay, so we look at that 5-year period. I like to chunk it out in 5 years so that sometimes we can have different things occurring that can affect that. An example being, if you're retiring and you haven't, depending on when you're going to start taking Social Security, if you're going to have a pension and when that starts, all these different, you could have other income streams coming in at different times. If married, one might start Social Security at one point in time and another at another point in time. And again, the pension piece could fit in. If you have rental income, how that would be impacted. So we look at all that. Our goal being that over this first 5-year period, what money we're going to need to supplement income or provide income, that we've got a plan for that. And it's invested differently in the 5-year period than it would be if it's in 5 to 10 years. If it's money we're not going to need, right, until year 6, and it's going to be for that next 5-year period, that one we can invest differently than money we're going to need more immediately. Your time horizons play a big part in this as to how that works for you specifically. So we also get into, so now you've got a short-term fund, you've got an intermediate-term fund, and then you're also going to have a long-term fund, 10 plus years. The longer your time horizon, the more aggressive you can be based on your risk tolerance, of course, your comfort level with the volatility, but the more aggressive you can be in investing for return. So what we're doing is we're going to determine, well, first off, what's the needed rate of return? And we do that through the planning I talk about. We look at your income, and we factor on that income any costs of living. So whether it's wages initially, so let's say you're getting ready to retire and you got wages, and then you're going to transition to Social Security, and again maybe a pension, maybe not. Other things you might have for income in retirement from rental or whatever it might be. Maybe you're going to work part-time. Take all this into consideration, and we're going to plug in the gaps needed to be able to provide, first off, for your current lifestyle. What does it take to maintain your current lifestyle? And then we say fund, we call it fund money, and that's to attain maybe a higher level. Maybe you want an extra $5,000 or $10,000 or $20,000 or whatever it is a year to be able to do fun things, leisure activities, travel, whatever it might be. Maybe, there's, for everyone it's a little different. We want to make sure you're properly funded for that. Once we determine what the needed rate of return is to accomplish your financial goals, then we build that investment plan according to those needs. And we take into a lot of other considerations. There's estate planning, there's the tax piece of it. How do we minimize taxes while we're doing that? Because if we can minimize taxes, right, your money's going to last a lot longer because you're getting to keep more of it. It's not being wasted by overpaying taxes. And you'd be amazed, maybe not so much, but I'm amazed sometimes at how much people just wastefully overpay taxes simply because they don't know the rules or how to use the rules for their benefit. Another area, Roth conversions. we look at that. That's a great way to maybe have a long-term planning, long-term tax planning impact as far as reducing taxes. Working with some people just last week, and we're getting into both with the resources they have, we're putting together a pretty aggressive Roth conversion strategy, both to help them minimize taxes in the future because their required minimum distributions were going to be so high, it was going to push them into a much higher bracket. So by planning with a Roth conversion strategy, we're going to reduce down the amount that it's going to be impacted, meaning your traditional IRAs then would be lowered, less RMD, less taxable income. It'll work, and again, we at the same time are mindful of how we pay the taxes as we go. If you'd like to find out more about these kind of strategies, I'm sharing these with you. Hopefully it's helpful. Hopefully get you thinking, what might work for me? Would that strategy work for me? Don't just take these and do them on your own. We do a lot of research and a lot of back testing with your investments to do this. So in other words, I don't just haphazardly say, okay, yeah, go do a Roth conversion, and you convert an amount and it ends up pushing you into a 35% bracket or something, and now you've paid excess tax where maybe we could have kept you at least at 32 or maybe down to 28, 24 even. So one of the things we want to do is when I'm doing it is I'm doing a lot of testing with it. I put together the plan, we get an idea of where we're needing to get to, then we try to figure out how to get there, then we run the actual return to make sure that it's not going to trigger any hidden taxes, and we make sure that the effect is to keep in the bracket that we're. So there's a lot involved in doing up a proper Roth conversion plan, but when done properly, it could be very beneficial. If you'd like to find out more about it, we can do one for you, a personalized plan, 615-376-5325. There's the number. What this is, again, a comprehensive financial plan. We're going to do the investment analysis. In these volatile times, it's a great time to look at what the potential risk in your portfolio are and how to in fact improve by reducing the risk and maybe even improve returns at the same time over your current investments. I'll show you the model portfolios and some new defensive strategies that we're employing as well that we've had great success with. I'll share all that with you as a part of the planning. We'll get into, again, your income, expenses, and we add in for inflation so that we want to be mindful that you need $100,000 to live on today. It's going to be like $130,000, $140,000 in 10 years. Just to buy the same things. You need your income to be able to increase, which means your assets need to be able to increase to stay up with that, and of course to allow also for taxes on that money. And we do that kind of planning. So even on when those required minimum distributions come along, all of a sudden that's going to, what effect's that going to have on your taxes? We plan for that, and we allow for the taxes as a part of the planning when we're showing you your financial future and how your assets will grow or possibly shrink depending on what you're currently doing. And if they're going to shrink, we want to definitely employ some plans to change that to again make sure you don't have to ever worry about running out of money. A big part of that also is what's the rate of return on your money. We determine what's the needed rate of return to accomplish your goals and then build your investment plan around that. So again, first 10 callers, 615-376-5325. We answer questions on Social Security, Medicare. We get into those in great depth to help you, again, minimize health care costs and retirements, maximize your Social Security benefits, minimize taxation of your Social Security benefits. There's so much involved there. We deal with all the different risks that you're going to face, all the complexities that go along with retirement and all the rules and how they work and how to take advantage of them. So again, 615-376-5325. Tessa's standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right. I hope this has been helpful. I mean, I hope you're getting some things this morning, and it's allaying some fears, but at the same time I want you to stay disciplined. I do want you at the same time to look at what you're currently doing and make sure that you're properly positioned, that you're not taking on excess. I had a new client come in this past week, for instance, that I'm doing the investment analysis, and of course I see this all the time, and this is just one example where they had, I think it was like 20 different mutual funds. So 20 funds, and yet when we look at the report that I do for Morningstar, we get into what's called an overlap report that's a part of it. And what it shows is that even though they had 20 different funds, and you're thinking, wow, I'm pretty diversified, right? I got 20 different mutual funds. But the reality is most of those mutual funds own the same stocks. And this is that when I talk about being heavily weighted, meaning that you've got more things in this large cap area, in this large cap category, then are you really diverse? It's all, I might as well just get an S&P 500 index fund, in other words, and then I don't need 20 funds, I can have one fund. Now, it wasn't quite that bad. Some of those funds were bond funds, and there was a couple of small caps in there, so it wasn't too bad. But it was way overweighted on the large cap side because that's what's been doing so well over the last 10 plus years, almost 11 years now, I guess. So what do we want to do? Good time to have that asset allocation, to relook at that, review your current portfolio, look at ways that you can minimize volatility while still seeking to get that market return, that needed rate of return that you're going to need for your specific situation to accomplish your financial goals. And when you're getting into in fact, let me share a couple of things with you here. One of them, I'm going to get a slide of 57%, this is a recent study, and talk 57% of retirees which they had done more planning, right? This is the area that you want to be thinking more of. It's that, not that, you know, people talk about what their needs are, right? Well, one of them is this need for planning. It's the way to make sure that you're going to be able to attain your goals. I think there's an old adage, what was it? Failing to plan is planning to fail. Let's not do that. All right, we're going to take a break. Join us here. We'll be right back on the Retirement Report.